Good afternoon. Since the previous meeting of the Monetary Policy Committee, the inflation outlook has improved. Food price inflation has moderated faster than expected. Domestic demand pressures remain subdued, and international oil prices have declined. Despite a degree of volatility, the rand exchange rate has been relatively resilient in the face of expected monetary policy tightening in some advanced economies, as well as domestic political risks and uncertainties. Risks to the inflation outlook still remain. At the same time, domestic growth prospects have deteriorated further following the surprise GDP contraction in the first quarter of 2017. The economy has now recorded 2 successive quarters of negative growth, and although a near-term improvement is expected, the outlook remains challenging. A number of sentiment indicators and data points have reached levels last seen during the 2009 recession, at the height of the global financial crisis. The year-on-year inflation rate, as measured by Consumer Price Index, for all urban areas measured 5.4% and 5.1% in May and June, in line with the bank's short-term forecast. Food and non-alcoholic beverage inflation measured 6.9% in both months, with the contribution to the overall inflation outcome unchanged at 1.2 percentage points. Meat prices continued to accelerate, and at 13.0% contributed to the downside stickiness of food price inflation. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 4.8% in both months. Producer price inflation for final manufactured goods measured 4.6% in April and 4.8% in May. The further moderation in food prices was reflected in the PPI, with the category of food products, beverages, and tobacco products decelerating for the 7th consecutive month to 5.8%. The divergent trends between the categories of products of crops and horticulture and live animals persisted, with year-on-year changes of minus 24.4% and 21.4% respectively. The bank's forecast for headline CPI inflation has shown a marked improvement since the previous meeting. The annual average forecast has been revised down by 0.4 percentage points in 2017 and 2018, and by 0.3 percentage points in 2019 to 5.3%, 4.9%, and 5.2%. A lower turning point of 4.6% is expected in the first quarter of 2018, previously 5.1%, and an average of 5.2% is forecast for the final quarter of 2019. The main drivers of the improved forecast were the lower starting point, revised assumptions regarding international oil prices, domestic electricity tariffs, and the real effective exchange rate, and a wider output gap. These assumptions are set out in the annexure to this statement. Food price inflation is also expected to be more subdued due to a lower starting point and more favorable domestic crop estimates. Despite a persistent upward trend in meat price inflation, the forecast for food inflation has been revised down from 7.7% to 7.3% for this year, and from 5.4% to 5.1% in 2018. The forecast for 2019 is unchanged at 5.5%. The improvement is also evident in the core inflation outlook, with average forecast of 4.8% for 2017 and 2018 and 4.9% for 2019. This compares with previous forecasts of 5.0%, 5.1%, and 5.3% for these years. This improvement is driven in part by lower unit labor costs in addition to the exchange rate and output gap developments. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research, show a marginal improvement, with average expectations slightly below 6% in all 3 years. The decline was most marked among analysts, particularly over the first 2 survey years, and to a lesser extent among labor unionists. Both these categories of respondents expect inflation to be within the target range over the forecast period. The expectations of business respondents are largely unchanged and remain above 6% for all the 3 years. By contrast, 5-year expectations of all groups edged up from 5.7% to 5.9% and ranged between 5.5% for analysts and 6.3% for business respondents. Median inflation expectations of market analysts improved over the near term. According to the Reuters Econometer survey conducted in July, expected inflation declined by 0.2 percentage points to 5.5% in 2007 and to 5.3% in 2018 compared with the May survey. However, the longer-term trend is reversed with an expectation of 5.5% in 2019. Expectations implicit in the difference between nominal bonds and inflation-linked bonds have also declined slightly since the previous meeting, with the 5-year break-even rate at 5.3%. The global growth backdrop remains positive, with sustained upswing evident in most regions. This is despite continued uncertainty regarding economic policy reforms in the US, and nevertheless, growth rates and potential output estimates are still generally lower than those in the pre-crisis period. While there are lingering concerns about financial stability, risks from the shadow banking sector in China, the recent strong performance of the economy has contributed to the favorable environment for emerging markets. Underlying global inflation trends remain benign, with inflation below target in most of the advanced economies, notwithstanding the positive growth prognosis and tightening labor markets. An exception is the United Kingdom, where inflation has accelerated in the wake of the Brexit-induced depreciation of sterling. The subdued global inflation outlook is reinforced by generally slow wage and productivity growth in developed economies. Despite the absence of inflationary pressures, central banks in a number of advanced economies have signaled intentions to move from highly accommodative monetary policy stances. These countries include the US, the UK, the Euro area, and Canada. This process is unlikely to be smooth or perfectly synchronized and could generate bouts of uncertainty. In the US, expectations of further near-term rate increases by the Fed have been scaled down following a succession of downside inflation surprises. The gradual nature of the planned balance sheet contraction by the Fed has also been well communicated and appears to be largely priced in by the markets. While changing expectations regarding ECB and US monetary policy in particular have impacted on a number of emerging market currencies and bond yields, the reaction has been relatively muted, and a repeat of the 2013 so-called taper tantrum episode is not expected. Those economies that were most sensitive to that episode have much improved macroeconomic balances, and their currencies are less vulnerable to possible spillover effects from gradual monetary tightening in the advanced economies. The rand has also been affected by these changing expectations, as well as by domestic political developments, including concerns about a proposal to change the SARB's monetary policy mandate. While the rand is more or less unchanged since the previous meeting of the MPC, it has been relatively volatile, having fluctuated in a range between 12.60 and 13.60 against the US dollar. The rand's relative resilience had been underpinned by the generally positive sentiment towards emerging markets, as well as by sustained trade surpluses. The current account deficit is still expected to widen over the forecast period, but the degree of widening has been revised down. The rand remains vulnerable to increased global risk aversion, domestic political shocks, and the possibility of further ratings downgrades. The domestic growth outlook remains a concern, following the surprise broad-based GDP growth contraction during the first quarter of this year. With the exception of the primary sector, all sectors recorded negative growth. While positive growth is expected in the second quarter, the bank's annual growth forecasts have been revised down further. The forecast for 2017 has been adjusted down from 1% to 0.5%, and the forecast for 2018 is down from 1.5% to 1.2%. Growth of 1.5% is expected in 2019 compared with 1.7% previously. As a result of these trends, the output gap has widened somewhat, despite a further downward revision to potential output growth by 0.3 percentage points for each year to 1.1% in 2017 and rising to 1.3% in 2019. The weak outlook is consistent with the decline in the RMB BER Business Confidence Index to levels last seen during the recession following the global financial crisis. The SARB's composite leading business indicator has also moderated somewhat since January. Monthly data for both the mining and manufacturing sectors in April and May suggests that in the absence of a sharp contraction in June, these sectors are likely to contribute positively to growth in the second quarter, along with the continued rebound in the agricultural sector. The recovery is nevertheless expected to be modest, particularly in the light of a sharp fall in the ABSA Purchasing Managers Index in June, which returned to below the neutral level of 50 index points. The construction sector also remains under pressure following the marked fall in building plans passed in the first quarter of this year, with the negative trend continuing in April. The continued poor performance of gross fixed capital formation contributes to the weak state of the economy. Although private sector investment recorded positive growth after 5 consecutive quarters of contraction at a growth rate of 1.2%, it remains very subdued. Given the extremely low level of business confidence, a near-term improvement is unlikely. Policy uncertainty, a recent example being in the mining sector, is likely to constrain investment. As a consequence, employment growth has been minimal and the prospects are unfavorable. Given the need for fiscal consolidation, a continued decline in government's contribution to employment creation is expected. The official unemployment rate increased to 27.7% in the first quarter of this year. Consumption expenditure by households contracted in the first quarter of this year amid a further deterioration in consumer confidence. Although the monthly retail sales data suggests a more positive outcome for second quarter, This improvement is likely to be offset in part by a decrease in new vehicle sales in the quarter. The outlook for consumption expenditure is expected to remain weak amid employment uncertainty and higher tax burdens. These consumption trends are mirrored in the continued moderation in credit extension to households. Growth in mortgage advances and installment sales credit finance remained subdued, reflective of the difficult conditions in the housing and vehicle markets. General loans to households increased moderately in May, but off a low base. Credit extension to the corporate sector, by contrast, remains relatively buoyant, but on a downward trend. Wage trends have been an important contributor to the persistence of inflation at higher levels. There are, however, indications of some moderation in average salaries and related unit labor costs, which are expected to remain below the 6% level over the forecast period. The outcome of a number of multi-year wage agreements that are due for renewal in 2017 will be closely watched, as they would pose a risk to the inflation trajectory. The persistent global oil supply glut, along with increased shale gas production in the US, have undermined efforts by OPEC and other producers to support prices through output restrictions. Since the beginning of June, Brent crude oil prices have traded at levels below $50 per barrel, and the bank's oil price assumptions have been revised down over the forecast period. These recent oil price trends, along with the stronger exchange rate, contributed to a 69% litre reduction in the petrol price in July. Following a weakening in the rand and a partial recovery in crude oil prices, a moderate petrol price increase is expected in August. The inflation outlook has improved significantly since the previous meeting of the MPC and has been fairly broad-based. The lower core inflation outlook is indicative of weaker underlying inflation pressures at a time when the impact of exogenous shocks on headline inflation has been dissipating. These shocks include drought-induced food price inflation and, to a lesser extent, international oil price increases earlier this year that have since been reversed. A number of risks to the inflation outlook persist, and the MPC assesses the risks to the inflation outlook to be broadly balanced. Although the rand has been relatively resilient, it remains vulnerable to heightened political uncertainty, global monetary policy developments, and possible further credit ratings downgrades. On the positive side, it is supported by a sustained narrowing of the current account deficit and positive investor sentiment toward emerging markets. A further upside risk relates to the possible supply-side shock of a large electricity tariff increase from July next year. Eskom has approached NERSA for an increase of around 20%, but the current forecast assumes an increase of 8%. This assumption will be adjusted in line with any new determinations made by NERSA. The MPC remains concerned that inflation expectations remain sticky at the upper end of the range. To the extent that these expectations are formed adaptively, they should adjust downwards if the lower inflation trajectory is sustained. The MPC would prefer expectations to be anchored closer to the midpoint of the target range. Underlying demand in the economy is extremely weak, and the MPC is concerned about the deterioration in the growth outlook over the forecast period. This decline is broad-based. It is unclear where the drivers of accelerated growth will come from, in the absence of credible structural initiatives that will reduce uncertainty and increase business and consumer confidence. The MPC assesses the risks to the revised growth forecast to be slightly on the downside. Given the improved inflation outlook and the deteriorated growth outlook, The MPC has decided to reduce the repurchase rate by 25 basis points with effect from the 21st of July 2017 to 6.75% per annum. 4 members preferred a reduction, whilst 2 members preferred an unchanged stance. As we have emphasized on numerous occasions, the MPC does not view monetary policy as the solution to the structural growth constraints in the economy, nor does it believe that a reduction in interest rates will provide a significant stimulus to growth in the current environment of low confidence and political uncertainty. It will, however, provide some relief at the margin. In this highly uncertain environment, future policy decisions will be dependent on data outcomes and our assessment of the balance of risks. We remain vigilant and would not hesitate to reverse this decision should the inflation outlook and risks deteriorate. Thank you very much, ladies and gentlemen. Let us now turn to the questions, and as usual, please identify yourself and the media house that you represent, and this distinguished panel will then address your questions. Arabile.
Good afternoon, Governor. Arabile Komete, Bloomberg News. I just have 2 very quick questions. One, did you fear in making your decision as the MPC that the questions of a change in your mandate played a significant role in the decision you took to decrease rates this time around? And at the same time, are you then concerned about the credibility that you would have to hold having made a decision to cut rates, not just from here on, but not just today, but from here on as well? Thank you.
Yes, ma'am.
Olivia Commander from Reuters. Some market analysts had said like a rate cut today would be viewed as giving in to political pressure. Just to add on to Arabile's question, what do you think about that? Are you giving in to political pressure? Thanks.
Miriam.
Thank you, Governor. I managed there. It's Mariam Issa from Finweek. You did mention that there were a few outstanding risks to the rand, which will, of course, affect the inflation rate, which you said the outlook of the risks being broadly neutral. And one of the risks you mentioned was that of further credit rating downgrades, which could actually lead to downgrades also in the local credit rating from both Moody's and Standard & Poor's, since they're both on a negative at the rung just above that, a negative outlook. And I just wondered, I mean, how big a risk do you think this is, given the state that policymaking in the economy and political risk is perceived at the moment? And if this were to happen and local government bonds drop out of global bond indexes, what sort of outflows would you expect from the local bond market, and what sort of impact might this have on the rand?
Tshepo.
Good afternoon, Governor. I understand you do visit the BIS in Switzerland quite often. On the role of the Reserve Bank, Governor, are there any commitment that we have internationally, maybe with your likes of BIS, that we may have that may commit us in the event that maybe lawmakers decide that they may change the role of the Reserve Bank, that perhaps maybe it might not be in line with those international commitments as a central bank that we may have? I hope it's clear.
Okay. Shall we take the last one in this round? Yes, ma'am.
Good afternoon. I'm Mukhelang Bata from Bloomberg. Governor, you have mentioned that we are living in pretty uncertain times in terms of policy in South Africa. We've also, at the recent ANC policy conference, heard of a proposal to take the ownership of the South African Reserve Bank out of private hands and possibly nationalize it. This, of course, coming amid, the public protector's recommendations, which, were a proposal to change the mandate of the SARB. I mean, in what context is the SARB operating now? Is it vulnerable to its independence and credibility being undermined due to political proposals that are being put out there?
Okay. Let me deal with the real questions first, and I will come to the peripheral questions. Miriam, the risks to the outlook and how big are the risks to the credit ratings downgrade? It's all going to be a function of which risk you are measuring. Is it the risk that you will be downgraded, or is it the risks of what will happen once you are downgraded? And I tend to focus on what are the risks should we be downgraded. If we get downgraded, in this case by both Moody's and Standard & Poor's with respect to the local currency denominated bonds, we will fall out of the World Government Bond Index. It's a very important index and is tracked very closely by investors. It's dominated by what are called index trackers, which means that you almost have a natural demand tagged to your weight in that index. What would happen should we fall in depends on whether investors, when we were put on a negative outlook, decided to start selling South African bonds or not. That is one leg. The second leg has to do with if the investors who are tracking that government bond index pull out, who buys? If they sell, who buys? What would happen is that South Africa will fall into a category in rating terms called speculative grade. That is generally referred to as junk, but the official term is speculative grade. So that would mean that it complicates the calculation of how much the outflows are going to be, because there might be outflows of investors who only invest in investment grade, but you could be bought by investors who are buying speculative grade bonds. South Africa is still a solid credit, which would mean that even investors who buy speculative grade bonds could look at it and say that this is a good quality speculative grade investment. So it's then difficult to then calculate exactly what the outflows would be, because there would be outflows and there would be inflows at the same time. Problem is, those speculative grade investors are very unreliable. That's why it's called speculative. They come in and out at the pressing of a button, and they are not particularly reliable. And South Africa should thus focus its efforts on dealing with the credit rating concerns so that we could retain our investment grade rating, because we would prefer to have those high grade investors rather than speculative grade investors. And okay, I thought that I will deal with more serious questions. It looks like the majority of the questions are peripheral. Changes to our mandate, did we feel under pressure? Let's start with Arabile in this meeting, and are we concerned about our credibility? We are not concerned about our credibility. And it's not because somebody gave us the credibility. We earned it. We earned our credibility, and we will protect it. because we have got a constitutional duty to protect the value of the currency in the interest of balanced and sustainable growth in the Republic. So there is no issue about our credibility. And we are cognizant of the fact that should we lose that credibility, it will take a long time to regain it, if you regain it at all. Now, did we fear changes in our mandate? And were we under any political pressure? These questions are related. Let me repeat. No president, past or present, no minister of finance, past or present, had ever attempted to tell the SARB how to go about in executing its mandate. The reason it is so is that as we are sitting here, we are standing on the shoulders of the giants that preceded us. We had very, very strong governors that anyone who thought they could give an instruction knew that they would be faced with a significant rebuttal. I don't think anybody wants to try it this time around either. So, we have not been under any political pressure. I think that the message got very clear very quickly. Don't attempt it, and we have not seen it. There is the question of ownership that I had been raised that I would like to deal with, which you said had come at some policy conference which none of us attends. The notion of a central bank as a public policy institution with the main goal of promoting monetary and financial stability in the interest of the general public is remote from the traditional concept of commercial company with a profit motive. In this vein, the South African Reserve Bank is an independent legal person and a public institution that has no political motive and is not controlled by shareholders or anyone else for that matter. Accordingly, shareholders in the SARB have very limited rights, have no role whatsoever in influencing the setting or the implementation of monetary policy. They have no sway over the day-to-day management of the SARB. They receive a fixed return on their shares of 10 cents per share from profits made. This amounts to an overall dividend payment by the bank of 200,000 rands per year. Mind you, the SARB made a profit of 1.4 billion rands. The shareholders only get 200,000 rands from that money. Neither do shareholders have any claim on the reserves of the bank. The reserves that we hold are held on behalf of all South Africans. They do not belong to the shareholders, and neither do they have any influence on the management thereof. The shareholders are unable, by means of a resolution or otherwise, to amend or change the bank's legislation. Neither do they have the power to order its affairs by amending or deviating from the prescriptions of the Act. The management of the business of the bank, including the setting of monetary policy, rests in the governor and the deputy governors, who are appointed by the president after consultation with the Minister of Finance and the board. The governor and the deputy governors are clothed with great decentralized powers of management, whilst the governance of the bank vests in the board, which similarly is vested with the decentralized original powers of oversight of the bank. So, the board is a governance board. The shareholders do not have any role in the policy mandate of the bank, neither do they have any role in the running of the bank. So what power do they have? Well, if you are a shareholder, you have got the privilege of being invited to the annual general meeting. And when you are at the annual general meeting, you can vote for the appointment of auditors, and you can vote for how much those auditors are remunerated. That is it. And after that, we will serve you tea and biscuits in the foyer, and if you are lucky, we might serve you some savory treats. So, what would then happen if the government takes over the shareholding from the rest of the shareholders that have a stake in the bank? Well, that will mean that there will be one shareholder attending the AGM. That could make the AGM go a little bit quicker. The board will still be 15 people. The difference will be that they will all be appointed by government. The board will have exactly the same power as they are having now. They will have no say on policy. They will have no say on the day-to-day operations of the bank, because the power lies with the governor and the deputy governors. I hope that deals with that question. Did we feel that our independence is under threat? No.
Well, there you go, the Reserve Bank Governor, Lesetja Kganyago. Again, we leave him while saying that his independence at the Reserve Bank was never a threat.
And uncertainty is not what South Africa is looking for at this stage. Be that as it may, in case South Africans forget, the independence of the Reserve Bank was enshrined in the interim constitution and the constitutional principles in 1993, before the final constitution was adopted. That means that when the constitution was adopted, the constitution was subjected to the Constitutional Court hearing to ensure that it is consistent with those principles. So it is not going to be that straightforward to change the mandate of the bank, because whatever change is made has got to be consistent with the original constitutional principles that were adopted in 1993. That deals with all of those questions. Can we talk monetary policy? Miriam.
Thank you, Governor. In the statement, the closing line, you point out that the bank is not going to hesitate to reverse this decision, i.e. the rate cut, should the inflation outlook and risks deteriorate. Now, if all things remain the same, if the risks to the inflation outlook remain neutral, the rand is broadly stable, and growth remains below potential, is there a chance of any further rate cuts in this cycle?
Like we say, any further policy moves in whatever direction will remain data dependent. So, if you come to the next MPC meeting, based on the data that we would be having at that time, we would tell you, based on the most recent data, this is the policy stance that we are taking. SARB.
Governor, you indicating that the stance to move away from accommodative monetary policy would not have the same impact as it had in the past. Does that include for South Africa, as countries like the US are looking at increasing their interest rates?
I'm not sure I understand the question. Any one of you understood it? No.
correctly, Governor, there's an indication in one of the page that the impact of interest rates going up in developed countries. Obviously, we will see that investors will go to countries where yields are higher, like US, and we've been benefiting from that. So the question is, are we likely to see that move affecting the rand?
Okay. Any other questions? Hillary?
Governor, you did mention that you would prefer to see expectations anchored closer to the midpoint. Mm-hmm. Now, are you concerned that by cutting rates now, you may send a signal that, 5%, which is where your forecasts are over the next couple of years, is good enough, and that may mitigate against expectations coming down towards the midpoint? Thanks.
Is there anything on the webcast? Nada. Any other questions? Miriam?
Just a small side question. The 7th seat of the MPC has been empty for some time. Is there any chance of it being filled in the near future?
Chaps, I have done what I was supposed to do. Minele, can you deal with the issue of the flows and the yield differentials and all of that thing? Who should I ask? Brian, Kuben, Rashad, you are both bold. All of three of you are bold. But can you deal with Hillary's question about the cutting of rates now, whether the cutting of rates now will not undermine our effort to drive inflation expectations towards the midpoint? It's a fairly complex question. I think it might need 3 brains.
Tsepo, I hope I understood the question correctly. I think it obviously speaks to one of the risks that we have indicated continues to obtain as far as the rand is concerned, depending on the evolution of adjustments in policy rates in advanced economies. Obviously, one of the factors that has supported the rand has led to this relative resilience that we talked about in the statement has had to do with constructive investor sentiments towards emerging markets in general, partly to do with the fact that investors seem to have taken comfort from the communication that came out of some of those central banks. I think in particular the Fed as the one that most were watching. They have time and again confirmed that based on developments in the US, they expect that they will be able to continue with a gradual adjustment in their policy rates, and also the new issue that has now come to the fore around plans that they've signaled with regards to reducing the size of their balance sheet. They've given reasonably clear guidelines in terms of how they're going to go about it and what would determine the pace, what the mix of the reduction would be between sort of conventional bonds and asset-backed securities. While these yield differentials would have played a role and people would have sort of invested in emerging markets in searching yields, should that reverse and should the policy adjustments in advanced countries proceed in the manner that is expected, some of it seems to be priced into the financial markets, so we don't expect abrupt changes. There will be an element of flows that will go into the other direction, but there shouldn't be anything too abrupt unless conditions, of course, change that require those policy adjustments to assume a different path from what is currently anticipated.
Thank you very much. Just to say, I mean, this was a very intense discussion. The extent to which the current stance is consistent with our objective of being more comfortably within the inflation target. And we think it is pretty consistent with that view. Firstly, I think that if you look at the inflation outlook, you're talking about 5.3%, 4.9%, and 5.2%. We're not talking of an outlook where we very close to 5.9, 6%, 6.1. And I think the critical question for us is that when we say that we want to be comfortably anchored much closer to the midpoint than has been the case in the past, we're obviously looking at this within the context of the state of the economy. We believe that coming out from a technical recession, credit growth being at zero, we believe that the slight cut in interest rate is consistent with an economy where we don't see demand-side inflation turning in a different direction very soon. So we do think that there's evidence of disinflationary forces. However, it's a very cautious approach we have, and we are very, very aware of the fact that if we begin to see evidence that we're moving back closer towards the target, we will act accordingly, because we really are monitoring very closely our attempts to keep inflation or expectations comfortably below the target, top end of the target.
Kuben, want to add something?
Yes, Chair. Inflation expectations are both backward-looking and forward-looking. The present level of inflation expectations is still higher than the forward forecast for CPI. We think that a sustained period of lower inflation and the CPI forecast that we would have would both positively contribute towards lowering inflation expectations going forward, because there is a degree of backward-looking behavior in the formation of inflation expectations.
Okay, thank you. Yes, who's webcasting?
A question from Peter Montalto. Do you or the other members of the MPC view this as a cycle or a small adjustment here, given the relative importance of the structural constraints in growth?
Is that the last one? And then
there's another question. Does the SARB have any views on Bitcoin and how the capital outflows through Bitcoin will be addressed by the SARB?
From the same gentleman. Francha, you can deal with the Bitcoins, my friend. And the other question, it's left for you, the other question too.
Both questions?
Yes. You have the last word.
Thank you, Governor. Dealing with the question that Peter raised, I think the fact that the economy is underperforming compared to potential is attributable, as we've alluded to in the statement, on the one end to structural factors, but clearly there are also cyclical factors. And I think we made the point very, very succinctly that the more accommodative stance does matter at the margin, because why do you have a monetary policy committee if we believe that monetary policy is totally impotent? And so I think we have acknowledged, and it's widely acknowledged if you look at reports by the IMF, that there are structural factors impeding growth. But I think it would be absolutely naive to think that it is merely structural factors that are impeding growth. There are clearly cyclical factors, and monetary policy does and can play a role to stimulate an economy where a slowdown is cyclical in nature. And of course, coming back to it, our primary mandate is focused on price stability. And that is our point of departure. And as we've pointed out very clearly within the statement, the inflationary trajectory has shown significant improvement over the last 6 months, and certainly since the previous meeting of the MPC. And so we are absolutely comfortable that that the decision today is absolutely consistent with our reaction function, and that we hopefully have very, very clearly communicated to the market in the past. There's certainly no deviation from our reaction function, as demonstrated as to our reasoning as to how we arrived at the decision today. Turning to the second question about Bitcoin, clearly, it's something that is occupying our minds. We are working internationally with our colleagues. We are monitoring developments, etc., and certainly engaging with industry, and we'll be monitoring it closely. I don't think the question of cryptocurrencies and its impact on international flows is limited to South Africa. It's certainly something that we monitor with our colleagues and where we are applying our minds. And if appropriate, we will look to regulate these things more closely.
Okay, as we close, let's be clear. Francois, you are also supposed to deal with how would the government do it if they have to remove the private shareholders.
Okay, thank you. Look, the question of sort of removal of private shareholders, as far as we understand the legal position is that potential purchase of all SARB shares by government would require the introduction of appropriate and suitable legislation or legislative measures, since the existing Reserve Bank Act does not currently provide for such a situation. And this legislation would also have to provide for measures such as the determination of the value of the shares as determined by the legislature. And obviously a number of other factors would have to be taken into account, not least any commitments in terms of international bilateral investment treaties, etc. But that is the legal situation. The current legislative framework does not provide for that, and that would require amendment.
Okay, just to be clear, Peter, I know you are listening, because you asked whether this is the commencement of a cycle or we are very clear that we did this in the environment that we are in to try and provide some support. We could only do this because we are now confident that inflation is well within our target, and that we would prefer that inflation expectations are anchored closer to the midpoint of the range rather than at the upper end of the range. Just one last word about this structural and cyclical thing so that we can become clear. The South African growth problem is not cyclical. So the two policies that affect cyclical growth, which is fiscal policy and monetary policy, affect growth on the margins. When you have got growth at low levels, even that marginal boost to growth becomes important. But we are very clear. Our focus is the protection of the value of the currency in the interests of balanced and sustainable growth in the Republic. So tinkering with monetary policy is not going to produce the engineers this economy needs. It's not going to build more ports. Tinkering with monetary policy is not going to produce more PhDs and so forth. You are going to have to go into the realm of structural reform and micro policies. That is where growth, sustainable growth comes from. It means you must lift the potential growth rate of the economy. As we stand with monetary policy, we can't change that potential growth of the economy for the benefit of SAPO. The potential growth of the economy is like the speed limit on the road. So you could try and stimulate the growth. As soon as you go beyond the speed limit, you are going to have problems. Fortunately, at the moment, we are still below the speed limit. So you need those structural reforms to lift the potential growth rate so that cyclical growth can be more balanced and sustainable. Thank you very much. That concludes the business of today.